started trading the financial markets.
Better futures start now with the NinjaTrader mobile app. With the power to customize how you trade on the go, you can quickly and easily place trades with a single swipe and view index, financial, energy, metal, crypto, and more futures markets, and access over 40 built-in indicators plus custom indicators, all from your phone. Stay up to date at all times by enabling notifications. Get started today at NinjaTrader.com. Technical analysis made easy. A starting place for new traders. When do I place my trade? Where do I set my stop loss or profit target? All good questions that traders need to answer on a regular basis. One of the ways traders get to those answers is by using technical analysis in a historical price chart.
Join over 800,000 users who trust NinjaTrader as their futures trading platform of choice. Access the world's most popular futures markets and trade seamlessly across devices, including PC, Mac, or mobile. Get started with $50 margins and commissions as low as 9 cents. Need support? We're available 24 hours a day, 5 days a week. Want to personalize your trading setup? Connect with our ecosystem of third-party developers building trading indicators and more. Visit NinjaTrader.com to get started today.
Better futures start now with the NinjaTrader mobile app. With the power to customize how you trade on the go, you can quickly and easily place trades with a single swipe and view index, financial, energy, metal, crypto, and more futures markets, and access over 40 built-in indicators plus custom indicators, all from your phone. Stay up to date at all times by enabling notifications. Get started today at NinjaTrader.com.
Join over 800,000 users who trust NinjaTrader as their futures trading platform of choice. Access the world's most popular futures markets and trade seamlessly across devices, including PC, Mac, or mobile. Get started with $50 margins and commissions as low as 9 cents. Need support? We're available 24 hours a day, 5 days a week. Want to personalize your trading setup? Connect with our ecosystem of third-party developers building trading indicators and more. Visit NinjaTrader.com to get started today.
Welcome back to NinjaTrader Live. I'll be your host for this segment. I'm Tom Schneider, CMT with NinjaTrader. And at Traders Workshop, we like to bring in our NinjaTrader ecosystem partners so they can share their experience with you. Today is no different. We are bringing back on founder of Mastering the Markets, Tiru Nagapan. How are you, Tiru?
Very good, Tom. Very good to be back again here.
Yeah, my pleasure. I always enjoy when we get to talk together, and coming off of the previous segment with Jim and Dr. Gary, that we have big shoes to fill.
That's right. Yeah, I always like Dr. Gary's ones. I like his example on the snowflakes and all that. We'll reference some of that in today's session too.
Oh, that's great. Yeah, I know you both have experience with the topic of volume spread analysis. And so, today we're going to focus, though, on putting it all together, I think.
Yeah, absolutely. And I think because we've done all the previous ones as well, I think that would be good to go into a nice recap today on basically price action strategy. How do you put a simple strategy together from everything that we've spoken about? So that's what today's all going to be about.
Awesome. Before we get into that, how's everything where you are?
Everything is good. As I was telling you, it's really getting roasting up here a bit. We are very lucky when we get that kind of a weather here, because I think you're asking me about air conditioning. I'm thinking, wow, when was the last time we talked about air conditioning here in the UK? Because we only get, if you're lucky, I mean, we get about 2 months of summer. Other than that, it's quite cold. It's pretty cold. Yeah.
Yeah, the times I've visited in London have been not in summer. So experienced the cold, and it's still quite lovely city. I mean, even in the off months, I would say off of summer. But yeah, that heat when it comes and you're not ready for it, man, it can take you by surprise for sure.
Tell me about it. That's right. Yeah. But we enjoy the summer when it comes because we don't really get much of it. It's beautiful. The whole city just changes when you get the nice light and everything. It's beautiful.
Love it, love it. So let's dig in. Let's talk about putting a strategy together.
Right. Let's take it step by step as we always do. I just want to quickly reference the previous videos that we have done together if people can't really understand. Yeah. All right. Okay. So not sure why is that. Do I need to share the other one maybe? Let me share the other one. Let me stop the share. Let me share the screen. Oops, this should be screen one. There we go. I think that should do it. That's right.
Excellent.
All right, there we go, guys. We got that tech out of the way. So I just wanted to quickly reference the previous videos that we did so that people who are listening in can reference those videos. This is the first one that we did. We took an overview of what we have done so far with the whole smart money framework indicator on the tree stats. And then after that, which got about 25,000 views, and then we went on to doing it with Jim, that we talked about how the trend actually forms, how the market structure is formed with this kind of methodology. Then we went on to then talk about how do we actually quantify the target setting. So then we looked at 3 types of targets, right? And then the last video that we did, we looked at stop losses. How do you manage market volatility? That nicely puts us into today's session, Tom, where we are talking about how do we put all this together from all the 4 sessions we've had together in putting a nice price action strategy, a very simple one. Now, before I start talking about the whole price action strategy, let me just bring up one of these ones here. Okay, that'd be good. So I can start writing on this. So here, just like any other strategy, and as you know, we always talk in terms of principles, right? So we never talk anything specific so that the viewers can apply to anything that they do. So likewise, what are the 5? I would start off with the 5 components for putting any strategy together, and then I will apply it on how we do it according to this framework. So the first thing that people should understand, in any strategy, there are 5 components. The first component is what we call the CO component. Now, the CO basically refers to the concept and the objective of the strategy, right? Now, people might be saying, now, why do I need that? So let me just give you a very quick analogy. So for example, if somebody has got a car business, right, and he wants to start to think of what kind of a car should he build, and if he's a businessman and he needs to make profit out of it, he would first do a geography data research, right? Are there 80% of the population, are they family orientated? Is it families or is it car sports raving fans, right? So if he decides that, you know what, I want to target, my target clientele is going to be families. Now, based on that objective that he's talked about, that he's put together, that he's going to target only families, target clientele, then of course the tools that he's going to choose later on to build a family car is totally different than to build a sports car. For example, the engine that he may need, he doesn't need a turbo boost engine, right?
Right.
He only needs like a, just like a good engine, a nice smooth ride, and he needs to choose 4 car doors, right? Because families, children, and all is easier rather than having 2 doors in a sports car and then squeezing to the back, right? So so everything starts to change. So that's why we start off with this concept and objective. In relation to this simple price action strategy that we're talking today, the concept is that price moves in cycles, which is what we've talked about before. That's the concept. So it's a swing trading based strategy. It's a momentum based strategy rather than opposed to maybe another strategy which you may start doing, which is mean reversion. So the concept of this strategy that I'm going to put together today is a momentum-based swing trading strategy based on the principle that price moves in cycles. Now, we understand that if it moves in cycles, it will make its swings, right? Tops and bottoms. So in this example, in this strategy that we're going to put together, we are only going to capture in trend. So I'm only going to look at only phase one moves, which is in alignment with the trend, right? And then the final concept of this is, since I'm taking a trend-based, momentum-based strategy, my concept is that every time I enter when a bottom is confirmed by the blue arrow and the dot, or a top is confirmed on a downtrend, I believe that the concept is that there will be move left in that phase one move. If there isn't, then I need to revisit the way I've quantified my tops and bottoms, right? So that's the whole concept. Now, what is then the objective? What am I looking to capture out of this strategy? I'm looking to capture, in this simple example I'll just give only one example of one strategy. I'm looking to capture the 80% distance, right, that this swing will be doing, right? That 80% of the blue dots will cover in a swing-based move. So that is the concept and objective of this particular strategy I'm doing. But the principles from here, they can apply to any strategy. The same thing, concept and objective. In fact, a lot of traders who come to us, that's the first thing I usually ask them, what's the concept and objective of your strategy? And they all will be like dumbfounded, look blank on me. And even this is people like with 10, 15 years of experience. And they're like, oh, I don't know what you're talking about. And I say, that's where you're struggling with the consistency, right? So that's where we start off first.
Now, Tiro, let's talk about that 80% because
Yeah.
I think that comes from your research. It comes from your research of the indicators, as we've talked about in earlier shows. Somebody else might have a different strategy, hopefully with different research, and they've observed something that is maybe not similar in structure or in behavior, but similar in concept, in the sense that you might identify when you're going to get into a trade and what's the expectation of that trade entry, right? It is essentially, what is the expectation of that trade, based on maybe analysis of history with that entry. It's like you said, you're not going in there blind saying, oh, I like this trade entry and we'll just see where it goes.
Spot on, Tom. That's it. I think you nailed it. It's about not going in blind. You have an idea, you've done some research, and it's based on recurring principles that the market keeps repeating. Because why we like this whole methodology is that in a swing, if you're entering when a bottom is confirmed according to your signal or based on volume, which I'm going to talk about later as well, which was designed by Trade Guide and everything that you're seeing over here, Gavin Holmes and his team, is that once you combine both of that, there's got to be a move left. If there is a move left, think about it logically. Why would someone buy into a position if they know for 100% there's no move left, it's going to turn against you immediately? Of course not, right? So whether you like it or not, people are always either buying or selling into a thing conceptually, thinking that there's move left. But the problem, what I've seen in the community, is that they don't know how much move is left. Right? So that when they get some retracements or some selling take off, they get panicky. And that's what we've been covering in all the previous videos, right? Which is what I was talking about in managing market volatility and all of these target kind of videos, right? We were talking about all of that. So people can always go and watch them back. So anyway, so moving on, right? So we got 4 more components, thinking of time as well. So concept and objective, right? So we covered that. Now, the second thing is what most people will know about, right? The second thing is the entry rules. Where are you going to enter? In this particular simple price action strategy that I'm going to share with you guys, is that whenever we have a phase 1 move, so I have to determine which is a phase 1 move. But to determine phase 1, I got to know my trend. And on NinjaTrader platform, we have already identified the trend. We've done the guesswork. We don't need to guess it anymore. We've done that coding for you guys. So as of now, on the 6P over here on GBP USD, you can see it's an uptrend, right? And for those who are quite inquisitive like myself, they might question, hey, why is it saying an uptrend? Because simply, if you draw a line diagram, connect all the blue arrows with the orange arrows here, you can clearly see that it's making a higher highs and higher lows. So that's why it's an uptrend. So that's the first thing. After you've defined the trend, so the first thing is always define the trend. Even this, people who have 10 years of experience trading, they don't know because they do not have a market structure, which is what we've spoken about in the previous videos. Now, once you've defined your trend, then you know that which will be a phase one, because in an uptrend, right? So once you've defined your trend, so in an uptrend, the bottom to top will be a phase one because the bottom to top move is in the same direction as the uptrend, right? So that there you go. So that's bottom to top in an uptrend is your phase one. And in a downtrend, right, your top to bottom is a phase one. Okay, same direction.
Sure.
Now, when it's no longer a trend, we don't do anything. We keep our hands behind, right? Our legs, and we sit back. It's what Dr. Gary Dayton was saying as well, you know, and a lot of good traders, you know, have patience. Patience is very, very important. Discipline is very important to have that consistency. You know, sometimes I get clients who are a bit impatient, who have not been trained and reprogrammed yet. They say, Tiru, why are we not taking a trade? We need to be taking a trade every day. No, it's not. We got to follow the rules, right? We got to preserve our profits, not give it away. So for that, we need to wait for our setups, which have been clearly defined. So that's the entry rules there, right? So phase one, right? Only phase one dots we're going to take. So we first define the trend, take the phase one trades. And when do we enter is when we get the confirmation bar. So the confirmation bar is the one with the blue dot or the blue or the orange dot, right? So either this one, the orange dot over here, or the blue dot over here, which you can see over there, according to the trend. So you see, so phase one, and then we enter on the confirmation bar, the bar with the dot. And where do we exactly enter on the confirmation bar? On the close of the confirmation bar. Okay, so those will be the entry rules. And then there will be exceptions, of course, to it, but I don't have much time. But we won't go through that. So that's...
And Tiro, real quick, I know we're respectful of time. That's the key part. It's not just always about signals. It's when you get the signal, where do you enter, right?
Exactly.
And like you said, it's confirmation bars. We will do it at a certain value, let's say the close of the bar. You know, it's not just see the signal and go long or see the signal and go short.
Spot on. And you know, waiting for a signal really pays off. And I always keep highlighting to clients, you see, just imagine if you didn't wait for the blue dot to appear, how much money you would have saved by just getting in and just getting whacked on that short.
Yes.
Right, trade. So it really, really helps you clearly define rules. So that's the thing first. So that's the entry rules there. So in this simple price action strategy, phase one, only we take confirmation bar, close is where we're entering with exception rules that you need to write down. And as I said, these are principles. You can come up with your own rules, but always have some exception rules where you won't be taking the trade or you'll be reducing your risk on that probability trade. Right, now let's move on to the third component. So the third component is the stop loss rules. Now, where do I put my stop loss? Is the usual question people usually ask. Now, the stop loss, right? First of all, before I answer that, it's subdivided into two parts. One is your initial stop loss rules, and the other one is your trailing stop loss rules. So when I get into the trade, what is the initial place I'm going to put my stop loss? And remember, this is what we spoke about in our previous video about where we talked about managing risk, right? Or managing market volatility, right? So where we talked about all the different MAE numbers. So basically, the usual one that I always quote from my US client is, how much room do you give for the dance to occur before it gets to your target, right? And which we technically call the volatility, right? How much room do you give, but still make all the numbers work in terms of your reward to risk and everything and your net profit at the end? So that is the stop loss rules. In this example strategy here, we will put the initial stop loss, keep it very simple. I'm just giving a very rough example. We'll put it for the swing low, okay? If you're taking a long, right? So we'll put it for the swing low. If we want to make it a bit tighter, for those people who think, you know what, oh man, that's quite far off, you know, I used to think that before as well. Only it took me time to understand you've got to give room for the volatility. Right. But if you want to keep it a bit tighter, you can use the MAE stats, which we have programmed before, and we've talked on the previous video as well, maximum adverse excursion.
I really like those, by the way.
Yeah, that's
I
right.
really
Thank you.
like that whole explanation. So go back and watch that if you can.
Yeah. So that's on the initial stop loss. Now, then the next thing is once the trade moves, right? Then how do you manage the trade? How do you trail your stop loss? Again, we could be careful, right? Because if we aggressively trail it, we might get stopped out and then it goes back towards our target. So how do we do that? Over here, we have found that one of the best ways is if I enter where the swing is confirmed here, I wait for some selling, some seller bars. If it happens, I don't trail my stop loss yet. I wait for that selling to be cleared, right? So if I were to draw that, and I think I've covered it in the previous one as well. So if I were to do that, so it's going up nicely in your favor, a nice long position, nice open profit, comes back against you. You're like, oh man, is it going to go further down against me or not? So at that point, if you still believe, according to our market structure, it's going to go further up in your open equity data, we hold on to that trade and we wait for it to clear this potential top, which is what we have spoken about before. So once it clears that potential top, give it some time to dance around, right? And then it clears that potential top, and then I trail my stop loss to the low of that. In other words, if you really look back, I'm waiting for all the stops to be taken out before it resumes in its direction. Right?
That makes sense. That makes a lot of sense because, you know, there are orders there, there's price happiness there, and you know, when it resumes its trend, you've cleared those all out.
Spot on, right? So that's the trailing stop loss, right? So you guys got to think of your own ones as well. So now we go on to the fourth component. The fourth component is the target rules. Where do I get out? And that's what we spoke in the last two videos before, right? On the OE setting rules and all that, looking at the stats. So here in this example, I'll put it for the 80% open equity distance. In currencies, is usually what we found. One is we always choose a raw distance, right? Which is if you measure a runner, what is his raw distance that it covers, right? In meters, let's say. In this currency, usually pips. So we found that it's usually 25 pips, the 80% distance. And we also get an ATR-based target too, to give, to adapt for the times when the market expands, right? So we use 0.2 ATR, what we found is the 80% distance, and then we use whichever is bigger, right? And if neither of this target is reached, and also the stop loss is not hit, but an opposite confirmation bar happens. So for example, in this instance, if it keeps going up, and then after that, that hasn't hit the target yet, but it did an opposite confirmation bar with an orange dot, that tells me the race is over because the bottom to top move is finished because the top has been confirmed. So at that time, what do I do? If the target is not hit, the stop loss not hit, I exit on the close of the confirmation bar. Right. So that is the target rules, right? So those are the rules that on the simple price action strategy. Now, and then the fifth component in strategy construction is the risk management. You need to have a risk management section. Now, the risk management section, what you do is based on probabilities, and Dr. Gary Dayton spoke about this just now as well. You have to trade manage your trade based on risk, based on the higher probability setups, put your full 1% risk, 2% risk, whatever it is, your original risk. On the lower probability setups, which you need to define, then you reduce the risk on that. And for that, we have kind of got a probability kind of scoring system where we'll see whether the trade has got a high probability when we correlate different time frames. And actually, I will reference Ed Top here as well. Some of you would have heard of Ed Top, which is a very top trader. And he was interviewed in the New Market Visits, and he also mentions the same thing. He was a poker player, and he used to say that poker players, especially when professional poker players, they will only put a large part of their chips in when it's a high probability card that they got, right? And then when it's a medium probability, low probability, then they will risk manage accordingly and put very few chips in, and they keep waiting, right? Again, patience, right? So that's on the fifth component on risk management. Now, the final thing I do want to mention before I show some results on this as well, so not just talking, I'm going to show some results on this open equity strategy. The open equity strategy, you see, traders, what you have to understand is that open equity strategies, usually the one thing I always get is, okay, I put it for 25 pips on this 80% open equity strategy, which is just strategy number one. But after it hits the target, it keeps going up. And I get a lot of messages and calls saying, Tiru, why did you put the target at 25 pips, right?
Right,
it's
right.
going to the moon. What are you doing? And finally, I remind them two things. I say, one, this is just the objective of strategy one. That's it. I can create another strategy which catches the 50% OE and 20% OE. So it's not the end all be all, right? So that's only first strategy. The second thing is, however, people might say, okay, even on the 20% OE strategy, on strategy number 3, after you hit the target, it keeps going, right? So that's when I just want to mention to viewers and traders is that OE strategies have a limitation, right? The limitation is that they cannot capture never-ending runners.
Yes.
They cannot capture never-ending runners, guys who keeps going. And, recently, I mean, gold kept going up and up and up and up, right? They cannot capture never-ending runners. If you want to capture never-ending runners, no problem. We can create another strategy based on combination of selection, because you and I know, Tom, that not all of them, there's about 30 swings every year, right? On most instruments, tops and bottoms. Out of that, if you're looking at phase one, there's about 10 to 15 of them. And you and I know that between the 10 to 15 phase one moves, not all of them are going to reach the moon.
Right.
Right? There's only going to be a one or two. So again, selection. Because if you don't select, then you're fighting against your losses, which then really makes it hard to become profitable. So you need to have another strategy, combination of selection. And the selection, that's where we teamed up with Trade Guider and their team on a smart scanner and all the trade relative volume we got, because it helps us with the Wyckoff method as well, to help us select that never-ending runners, right? So that's how we are doing it. And then exit opposite confirmation bar or adaptable exit rules. I mean, there's so many ways to do it, and diversification is very important as well. So I would say selection and diversification. Now, the final thing I can say is with 2 minutes. Sorry, Tom. Yeah, carry on.
Yeah, just real quick. I like the way you pick your step 4. I just wanted to, point out what I really like about that is how you get out of a trade. You have several ways to get out of a trade, and they're adapting to the market. So you have one that's protective initially, then you have a trailing stop loss. You have the original target. But if the situation changes, like you said, in a phase one that's going up and you get the bearish indication, you get out right there. You don't wait for that stop to be hit. The situations change. That's why I like this. It's adaptive.
Exactly, spot on. Yeah, everything is thought of. And that's why I keep repeating that you're one of the best students I always get. You just catch it. You just capture all the points really fast and you really summarize it. Really great. Right, we got really running out of time, isn't it? So the quick summary on these results, I ran this on the GPUSD 6P for about 6 years, right? From 2018 all the way. The summary is here. So I ran it on a $10,000 account, but the risk management was actually done on a 50K. So we'll imagine this to be 50K, right? And on this, you can see that 8,236 net profit it finally got. So if you go down to the nitty-gritty detail, you'll find out that 8,236 is about 16.47% profit over 6 years, right? So that comes down to be about 2.74% per year. But that's just only one instrument, right? Only one instrument and end of day strategy. Okay, so really set it and forget, really hands-off strategy. But of course, we can always expand it on many instruments. Another thing, what you can also see here is that the profitable trades that we've got over here is about 90% of them. So 54 of them out of the 59 wins. So highly reliable, and 5 of them lose. But we just got to be careful before we jump on. And I know people get excited. The thing is, the profitable trades on average only 250, but the average loss is about 1,053, right? So it's about 4 times your winner. One more thing we as professionals always look at, we got to get prepared on the sequence or the order in which the losses or the wins can come. Because if you're really unlucky, you can get all the 3 out of the 5 losers coming right at the beginning at you. Look at this testing. The first one came at you. It took you about 4 trades to come out of that drawdown.
Yeah, that's one thing, Tiro, when I was working with back testing, you could have a strategy that's great, but if you hit those first 4 trades or 5 trades or whatever that are negative, then, you have a problem if you can't stomach it. And it's just a matter of risk management and just being aware that, over time, here are the results, but you just have to realize that, like you said, not every trade's a winner, and some could be consecutive losers that, you just have to be aware that that might be part of the situation as well.
Spot on, Tom. I think you really nicely summarized it. I think the last point only I would say is knowing all these stats and knowing all these logical things and knowing the 5 components gives you just the conviction, right? To stomach those losses and keep going forward. Then to realize all the profits that come later on, and finally to realize the true monetization of your profit, which what we are seeing over here, 16.47%. And you can run this on any instrument. So, and we are getting it on the NinjaTrader very shortly.
Excellent. Well, thank you so much, Tiro. As always, it's a pleasure to have you on and talk trading with you. Where can people reach you? What's the best ways?
I think the usual way, what I usually say, all the concepts that we've covered over here, get onto our email list. I think the first thing I would say is check out www.7steps2ctp.com. I think that would be great if you guys can check it, and if your team can put it on the YouTube channel as well, that'd be great as well. And then once you put your name and email and your number optional, then you get all the videos, which is all over here. Really, you will learn a lot. It took us about 15 years of collated research to put this together, and it will help you with any strategy that you are currently trading on.
Awesome. Thanks, Tiro. Again, 7steps2ctp.com. Go check it out. Pleasure again, and hope to see you soon. We'll see what happens, Tiro.
Yeah, definitely. Looking forward to seeing you and getting a drink with Gavin.
Yeah, I'm hoping. Plans are always changing, as you know, as you will know, as your little guy gets older. But we're going to take a quick break right now. We're going to be back with Mike Burke to wrap up the midday.
So, you want to be a trader? Well, you should know you're not alone. Over the past several years,